Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
One of the big movers in the marketplace today is Roblox. The game company stock is down 11%. It was down more than 20% earlier in the trading day. Bookings missed. Outlook a little bit softer than expected. Let's get some details on that. We can do that with Mandeep Singh. He's a senior technology analyst for Bloomberg Intelligence. Mandeep, describe what Roblox does, and then what's happening with the stock today.
I mean, this is a platform, think of it as a walled garden where you can play any user-generated game as well as, the AAA titles and all sorts of gaming content hosted inside Roblox platform where multiple users can play the game. And it's been quite popular, with that demographic, the 9 to 17, 18-year-olds.
It's a great way to entice somebody to do their homework. It really is.
Yeah,
it works.
The use case is beyond gaming.
You can spend 20 minutes doing this, after you do your homework or whatever.
Yeah, and so I think, again, user growth of 20% plus, and anytime you see a company missing on user growth, the reaction is pretty strong. Now, if you remember, there was a report from Hindenburg talking about how the user and engagement metrics are inflated. So pretty much the company has been, doing the cleanup post that report, even though they didn't really acknowledge, there were a large number of users.
Were they faking those numbers, or they're just so difficult to ascertain?
I think the problem with online platforms is it's so hard to figure out exactly, what's bot activity and where are the user metrics inflated or engagement. And there's always scope to, clean up and have real users being reflected on the platform. In the case of Roblox, brand safety is a big aspect because, we were talking about kids using the platform. So they've really, I think, done a lot since that short thesis from Hindenburg, and that's partly the reason why they missed in terms of the user and engagement metrics. But they called out Eastern Europe being weak and Turkey being weak. To me, this is really the quarter where the impact was the most obvious, and then it will gradually get better because they've cleaned up.
So it seems like at least a partial vindication for the Hindenburg research.
Well, I could make the case even for, a platform like Snap, where you may have, they have shown 100 million daily active users every quarter. Now, do they really have 100 million, or is it more 97 million because 3 million are just captured in their metrics? So no one has a consistent approach.
There's not a third party, like a Nielsen for TV ratings. There's no third party to verify.
There is no third party. Right. It's the company that's giving you the metrics, and I don't think there is like a consistent approach that every company uses in terms of giving out their daily active user count.
Beyond the daily active users, what are the other important metrics that you need to look at? Engagement
also was kind of a slight miss.
Well, in radio, it's time spent listening. Is that this sort of the same thing?
Yeah. So, again, I look at, what they are doing on the AI side. They are looking to develop their own foundational model. So think of it as, what the LLM companies are doing. It's a walled garden where they will create all sorts of tools to enable more content. It's similar to YouTube in some sense. YouTube has got a lot of video content. Roblox has got a lot of gaming content and other things for that demographic. So net, I mean, this seems to be a justified reaction because they missed on their numbers, but has the thesis really changed because they're losing share? I don't think so.
And real quick, have the safety concerns as a parent, have they been fully addressed?
That's what they're trying to address, and that's why they missed on these metrics. So they're using a combination of AI tools as well as just focusing more on brand safety because they want to ramp up ads. And the way you ramp up ads is you want to guarantee the advertisers that it's a safe platform to advertise on.
Mandeep Singh, thank you so much. We appreciate that. Mandeep Singh, senior technology analyst for Bloomberg Intelligence, joining us here in our Bloomberg Interactive Broker studio.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Our next guest, nice exposure to technology. And one of my questions is technology going to continue to lead this market higher? We're having a little bit of a hiccup so far in January.
It was the only sector to decline in the month of January, if I'm not mistaken.
And it's just kind of underperforming here. So Nancy Tengler, John, she's the CEO and CIO of Laffer Tengler Investments, based in, get this, right now, she's calling from Scottsdale, Arizona, one of my all-time favorite places.
Where there is no snow and ice on the ground,
no snow and
I'm
ice.
assuming.
The Royal Palms Hotel is my go-to place. They love me there. Lots of good stuff to do out there. Exactly. Nancy, thanks so much for joining us here. DeepSeek was a story a couple of weeks ago. We've now kind of forgotten about it. But I think that caused a lot of tech investors to kind of maybe rethink a little bit their AI trade here. How did you kind of view that news, and did it kind of change in any way your view of big tech?
Well, Paul and John, I'm dressed in sympathy for you this morning in a down vest, because it is actually cold here.
Define cold, Nancy.
Well, not really cold.
Yeah.
She knows I was going to whip out my violin and start playing.
Well, listen, I think there was a couple of things with the DeepSeek announcement. Remember on the Friday before we had Project Stargate, where the president had Larry Ellison, Sam Altman, and Masa Son in the White House announcing a $500 billion investment in AI. And whether or not it's going to be $5 billion, we could talk about that all for quite some time, but it generated enthusiasm. And then the next Monday, we had the story break that DeepSeek had developed a more efficient AI model for $5.6 million. I don't think that's correct. And I think there was, timing involved. And then we had Alibaba come out. What we know is that the system is not as reliable. It's censored. It crashed. And we also know that at Davos, where this was being talked about, and for months before DeepSeek, that is, that they allegedly have 50,000 H1 NVIDIA chips, which cost $40,000 each. So I think the whole thing is a bit suspect, but good for the overall AI market. Because what we know from Jevon's rule is that what you will see is the cheaper technology gets, the more the usage and the use case demand goes up. And we're seeing that across all sectors in earnings reports for the last 9 months and also this most recent quarter.
Nancy, what do we learn from the earnings reports so far? I mean, they're kind of backward looking. I guess more specifically, the earnings calls that we've had.
Yeah, John, no, you're absolutely right. So it is backward looking when you look at earnings beats, but what we listen to is the guidance, and what we're hearing is pretty optimistic. So if I'm going to look at my notes just a little bit, because we cover a lot of companies, but we're hearing things from companies as diverse as NextEra Energy, Raytheon, Xylem Water Treatment Company, and Prologis, for example. So old economy companies that are benefiting from the usage of AI in their businesses, and then the margin improvement is showing up in margins, and we're getting guidance that's pretty optimistic. And so you see that in the markets. What we also see is volatility, because we have Trump 2.0, and we know from Trump 1.0 that volatility will be with us. He's going to make bold statements, some of which will come true, many of which won't, but it'll rile the markets and it'll rile the algos and the short-term traders. As an investor, it's great news for me, because volatility is the friend of the long-term investor.
Nancy, I'm looking at your 12 best ideas portfolio. Very, very heavily weighted with the big tech names everybody knows: Spotify, Amazon, Broadcom, Microsoft, and the like. Talk to us about your thesis there behind that portfolio.
Yeah, so we run a growth strategy, Paul, and then we also run a dividend growth strategy, which is more value. And we always pull from there our 12 best ideas, because there was a study done decades ago that said optimal diversification is 12 names. And we have found that to be true over the years. That portfolio has done better than everything else. So we look for the companies that are generating earnings growth at a reasonable, not a cheap, but a reasonable valuation. And in determining that, we look at relative price to sales ratio. So what am I paying for a future unit of sales? And then the price earnings to growth ratio. And these are the names that we have confidence in. And in fact, it has shown up in the performance. So I think it's also got a heavy exposure to consumer discretionary, modest exposure to industrials via Uber, and then one healthcare name, and I think one financial, Goldman Sachs.
I learned from Paul this morning that there's high dispersion in the market. I want to ask you for a detailed explanation of that. But are we all riding the same? Are investors all riding the same wave?
Well, to some extent, and that's driven by the ETFs, John. So, when you see a big sell-off in a stock like Apple, a lot of times that's because retail investors or financial advisors are exiting ETFs, many of which own Apple. So you have to keep that in mind. But what we're looking at is an analogy to the 1990s. And I think we're in the early years of this analogy. Internet as a technology was, super cool, but we were measuring eyeballs. I wasn't, but analysts were. Eyeballs on a website. This technology is much more robust. And you've heard John Chambers, who was the CEO of the poster child of overvalued stocks in the 90s, say that generative AI and AI computing is more powerful than cloud computing and the internet combined. So in some periods of time, it makes sense to be part of the consensus, as long as you're not buying companies with multiples of 100 times peak earnings, which is what people were paying for Cisco in the day. And the buyers of the infrastructure are the hyperscalers who have robust balance sheets, many of whom are spending 50, 60, $75 billion this year in CapEx, but they're still generating 50, 60, $75 billion in free cash flow. So these are really sustainable, strong companies.
Nancy, thank you so much for joining us. Really appreciate it. Nancy Tengler, CEO and Chief Investment Officer at Laffer Tengler Investments. Oh, no, by the way, forecasted high for Scottsdale, Arizona today, 78 degrees. So there you go.
That's tough.
It is. They have a nice golf tournament there. The PGA is there in Scottsdale this week in Phoenix area, so they're going to have some good weather.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, let's talk to these markets here. Let's talk technology in these markets. Is technology still a leader for these equity markets as it has been forever? Shana Sissel joins us. She's the president and CEO of Banríon Capital Management, joining us here. Shana, a couple of weeks ago, it seems like a lifetime ago, there's this thing we all learned about, DeepSeek. And I know you guys spend a lot of time thinking about investing in technology, broadly defined. How did you guys think about this DeepSeek and what it may mean for technology investing?
So my general rule of thumb with any kind of news is if it makes me have a very visceral response, that I should step back and read. And so that was my initial response. The market, however, does not have the focus and the ability to necessarily do that. So it freaked out. As I learned more, I became less concerned about the DeepSeek threat and what that means for China as a competitor in the AI space. There's a number of things that stood out to me that made me think like, okay, this is no different than any time a Chinese company knocks off a American shoe brand or anything else. It's very similar, but there's more of a concern here. If we thought TikTok was a concern from a national security perspective, this is an even greater concern with its connections to the CCP through their app. So while there's definitely some interesting aspects of the open source code that can be used by Amazon or anybody to leverage, the actual app itself and the things as related to that, I'm less concerned about. In terms of what it means for U.S. companies in the tech space, this shouldn't be a surprise. It was always the greatest risk to technology companies in the U.S. was having somebody disrupt the market. But I think it's a bit overblown. And quite frankly, I think we've been complaining about valuations forever. And this solved our problem pretty quickly.
All right, let's move to Treasury yields. I heard the new Treasury Secretary say yesterday that he's kind of focused on the 10-year and bringing that down. Now, I'm kind of a student of history, and I have to go back to the early 60s and beyond, right up to present day. The 10-year seems to follow economic activity, and if you want to bring the 10-year lower, a sure way to do it is to lessen economic growth. I'm sure he doesn't want to do that.
Yeah, that's the conundrum here, right? You want to bring rates down, but at the end of the day, there is correlation there between the strength of the economy and the interest rate environment and the yield curve and how the yield curve behaves. The Fed doesn't have the power it thinks it has to control that. I mean, we've seen that in recent months with the Fed cutting and yet yield curve not behaving like rates have been cut. In fact, it's to be expected, right? Because you want to get out of an inverted yield curve, which requires the longer end to go up, even in a cutting cycle. But I think that the problem here and what they're trying to kind of fix is related to mortgage rates and the housing market. And I don't know that there's an easy fix to that. But I am concerned that there's this belief that if they just cut rates enough, they can fix this problem, because I think it's not that black and white. And there's a high probability of a potential mistake being made if they go in with policy decisions thinking that it is that easy.
Shana, I know you work with your clients talking about alternative investments here. Where do you see the greatest opportunity in alternatives here? Private equity, private credit, hedge funds? Where are you spending most of your time these days?
So more hedge fund-like strategies. Private equity, private credit are kind of sensitive to the interest rate environment and also sensitive to public market betas. In the hedge fund world, especially if you believe that there's going to be increased volatility, hedge funds and hedge fund-like strategies are great diversifiers. So, for example, last week, there's a ETF, BTAL. It's the AGF US Anti-Beta Fund. It's long, low beta, short, high beta. That product did remarkably well when we had the big DeepSeek threat sell-off. And that's exactly what you want in those types of products, and that's what hedge fund-like strategies can do, is provide you that downside protection when the market is under significant stress. Managed futures is another example, like a CTA ETF. And then when you move into the hedge fund space where they can use leverage more as a tool, you can get even greater benefit as a diversifier and as a downside protector. But it's not sexy, and people forget that, like, these aren't meant to outperform the market. They serve a purpose in your portfolio. I like to think of it as like home insurance. Like, you hope you never have to use it, but you would never not have it because you need to be able to manage the risk. And that's exactly how I see those types of strategies. This year, I think, is the year where these types of strategies are really going to show their worth because I think the markets are going to be quite volatile.
Shana, thank you so much for joining us. Always appreciate getting a few minutes of your time. Shana Sissel, President and CEO of Banríon Capital Management, joining us here talking about the broader market.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.